Record high equities and a simmering oil shock are pulling asset prices in opposite directions, while volatility stays surprisingly low. That tension between AI-fueled growth optimism and stubborn inflation risks is defining the cross-asset setup right now. You are watching vTalkInsight, Allocator's Lens Daily for May 28, 2026. In equities, the key story is that AI-powered growth is still lifting headline indices, even as macro risks build underneath. Major U.S. benchmarks, including the S&P 500, the NASDAQ 100, and small caps, are sitting at or near record highs, with a rally extending across several sessions. That price action is underpinned by strikingly strong earnings. S&P 500 profit growth is tracking around the high 20s year-on-year, well above earlier expectations, and forecasts for this year and next still point to double-digit gains. Several large Wall Street houses have responded by lifting S&P 500 targets toward the 8,000 area, framing this as an earnings-driven, not purely liquidity-driven, upswing. The most powerful engine remains semiconductors and AI infrastructure. Memory names like Micron and SK Hynix have moved to trillion-dollar market capitalizations. Drone prices have surged multiple times since last summer, and semiconductors have become the largest industry group in the S&P 500. Investors increasingly view the AI hardware cycle as infrastructure-like, with long-term contract from hyperscalers helping to smooth the old boom-bust pattern in memory and supporting a re-rating of the sector. At the same time, leadership is unusually narrow. Tech has been the only sector beating the index over the past month. Overall market participation is only a little above half of constituents, and gains are heavily concentrated in AI and semiconductor names. Micron's market value, for example, doubled from $500 billion to $1 trillion in under 2 months, with trading and options volumes exploding, which many see as a sign of frothy momentum and higher correction risk. Within technology, there is also growing dispersion. Snowflake surged after a strong earnings beat, higher guidance, and a multi-billion-dollar chip agreement that entrenches it in the AI ecosystem, while names like Zscaler and Salesforce sold off on disappointing outlooks, showing that the market is rewarding clear AI monetization and punishing any hint of slowing growth. On top of that, the coming SpaceX listing, with very concentrated voting control and fast-track index inclusion rules, raises questions about governance, index construction, and the role of passive flows when megacaps enter benchmarks quickly. For cross-asset allocator, that leaves a two-sided equity narrative. On one side, AI-driven capital expenditure and productivity gains are boosting margins across many sectors and appear strong enough for now to offset the drag from higher energy prices. On the other, valuations in leading names are stretched, equity gains are concentrated, consumer fundamentals are softening, and there is open discussion of stagflation risk if energy shocks from the Middle East persist. How equities digest upcoming PCE inflation data, further oil headlines, and the next wave of large tech and IPO news will be key signals before turning to what is now priced in rates. Rates markets are increasingly organized around a higher for longer outlook. Treasury yields, mortgage rates, and swap curves have all pushed higher as investors mark to market the idea that inflation will stay above target and that the rapid easing once priced in is unlikely. Headline inflation is expected to re-accelerate, with some forecasts seeing U.S. prints moving toward 4% in coming months, while core personal consumption expenditures inflation is projected to remain around 3% into year-end. Against that backdrop, central banks are sounding more hawkish even if they are not eager to hike aggressively. In the U.S., several Federal Reserve officials are talking about removing the easing bias from their communication, while still signaling an extended pause rather than immediate moves. The European Central Bank could deliver symbolic increases keyed to headline inflation, and the Bank of Japan now faces market odds of roughly 3 and 4 for a June hike as it worries that higher oil could entrench domestic price pressures. AI further complicates the picture. On one hand, AI-related capital spending is estimated to be providing a strong positive impulse to global growth, even outweighing the drag from more expensive energy, and a Federal Reserve study has highlighted potential productivity gains of 15 to 30% over time. On the other hand, supply constraints in chips and power infrastructure are adding to core inflation through higher hardware prices, with estimates that AI-linked memory shortages alone could be contributing around half a percentage point to core PCE this year. Scenario analysis for the U.S. curve reflects that tension. If the Fed were to ease policy into still strong growth and firm inflation, some see 10-year yields drifting toward or even above 5%, whereas a steady or slightly tighter stance could keep the range more contained in the mid-4% area. At the same time, G7 bond markets face reduced central bank buying and potential Treasury balance sheet runoff, which could further pressure term premia. For allocators, the interaction between these yield levels and equity valuations, as well as the emerging value in long-dated bonds as macro hedges, is an important cross-check before turning to credit. Credit markets currently present a split personality. In public markets, investment-grade spreads are hovering near their tightest levels since the early 2000s, signaling robust risk appetite and strong tolerance for new financing. Financing conditions look especially supportive in the UK, where advisory and merger activity has picked up sharply despite a mixed macro backdrop, and where valuation discounts continue to draw private equity and foreign buyers. Beneath that calm surface, stress is more visible in private and consumer segments. Investors are increasingly seeking liquidity from private credit funds that are heavy in riskier technology loans or loans vulnerable to AI disruption, with some managers putting withdrawal limits in place. At the retail level, delinquency rates are rising in buy now, pay later products, especially on smaller everyday purchases, and as that data begins to feed into traditional credit scores, it could tighten borrowing conditions for stretched households. Energy costs are a further headwind for credit quality. UK households, for example, face a double-digit percentage increase in regulated energy bills this summer, on top of already weak real wage growth and a soft labor market, which could pressure unsecured lending and consumer-facing businesses. In response to this more uncertain backdrop, many institutional portfolios are tilting toward higher quality assets, such as investment-grade bonds and raising cash buffers, while also considering shorter duration as a way to manage interest rate risk. How spreads behave if growth slows or if liquidity tightens will be an important signal before moving on to currencies. Foreign exchange markets are translating these growth and policy differences into currency moves. Despite recurring debate about its long-term role, the U.S. dollar is currently supported by strong asset flows into American equities, especially technology, and by better relative growth prospects compared with energy-challenged Europe. That said, some investors still argue for a structural short dollar view over the medium term, citing expensive valuations, limited room for additional Federal Reserve tightening, and persistent U.S. fiscal concerns. Policy divergence is particularly acute in Japan. Expectations for a Bank of Japan rate hike at the mid-June meeting have risen sharply, fueled by worries that higher oil prices could embed inflation and by political pressure to address yen weakness. A move from the Bank of Japan would mark a notable shift after years of ultra-loose policy and could have knock-on effects across carry trades and regional currency dynamics. Elsewhere, currencies of energy importers versus exporters remain sensitive to the evolving Strait of Hormuz situation and to European gas supply prospects into winter. Weaker labor markets in the UK and stronger tech-led growth in the US also point toward differentiated currency paths in coming months. Overall, FX continues to act as a release valve for the same forces shaping other assets. AI-driven U.S. outperformance, higher for longer rates, and energy security concerns, which sets the stage for a closer look at commodities. Commodities, and energy in particular, remain at the heart of the macro narrative. Renewed U.S. and Israeli strikes on Iranian assets and ongoing tensions in the Strait of Hormuz have kept geopolitical risk elevated and oil flows well below pre-conflict levels, even though some tankers continue to pass. Reports of nearly 2,000 ships waiting and volumes at less than a tenth of normal underscore the fragility of supply routes, helping hold Brent crude near the $100 mark after a gain of more than 30% since late February. Yet oil prices are also reacting sharply to shifting expectations about diplomacy. Headlines about possible U.S.-Iran understandings have at times pushed crude lower, with West Texas Intermediate recently dropping several percent and Brent slipping back toward the mid-90s on hopes of a more durable reopening of the strait. Those swings are filtering into broader commodity and even grocery prices, and they are central to whether inflation re-accelerates or begins to cool into the second half of the year. In gas, the picture is mixed. On the one hand, any prolonged disruption at Hormuz beyond midsummer could make it difficult for Europe to replenish inventories ahead of winter, reviving energy security concerns. On the other, mild weather, robust storage and demand management, especially in Asia, have kept European gas prices relatively range-bound, and many participants are now bearish on prices for the balance of 2026 compared with current forward curves. AI is also reshaping the power market. Data center developers are locking in long-term, investment-grade power contracts as base load capacity tightens, after years of underinvestment in nuclear and older gas plants, which is pushing up the price of reliable electricity. Meanwhile, gold sits at the crossroads of rates and geopolitics. Higher U.S. real yields and a firmer dollar have capped rallies this year, but ongoing geopolitical fragmentation and rising fiscal deficits, with U.S. interest costs projected to climb sharply, support the case for gold as a reserve diversifier and portfolio hedge. Together, these commodity dynamics will be crucial in determining whether the global backdrop tilts more toward benign disinflation or toward a stagflationary environment that feeds back into every other asset class. Putting it all together, cross-asset markets are balancing an AI-driven profits boom and strong U.S. exceptionalism against higher-for-longer interest rates, tight credit pricing, and an energy system exposed to geopolitical choke points. Equities are celebrating earnings and technology, but leadership is narrow. Rates are challenging stretch valuations. Credit is calm on the surface with more strain underneath. Currencies are tracking growth and policy divergence, and commodities remain the main swing factor for future inflation. For allocators, it is a moment to watch how upcoming PCE data, central bank meetings, Iran headlines, and sector breadth interact across assets, especially with implied volatility still subdued relative to the underlying risks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.